Thank you for joining us for this webinar today, where we are going to discuss financial planning topics that are relevant to you. My name is Cynthia Duncan, and I am today's moderator and a senior financial advisor at Summitry. I would like to begin by introducing our speakers for today. First, we have Adam Govani, who's a CFP and senior financial advisor at Summitry. Erin Zager, who's a CFP and senior financial advisor. And Mandy Pham, who has an alphabet of letters next to her name. She is a CFP, a CFA, an EA, and a senior financial advisor. I'm sure she would be happy to explain what those designations are during the Q&A if anyone is curious. Our vision for this webinar today is for the dialogue to be informal by design and reflect how we talk and think with each other as advisors about financial planning topics that impact the clients we work with every day. For today's webinar, we have selected 3 current topics to discuss: geopolitics, taxes, and inflation. Our goal is for you to gain perspective on which topics to focus on and which are okay to ignore. At the end, we will have plenty of time for questions and answers, where we will open it up to any questions related to personal finance. As a reminder, financial planning is highly personal, so although we will speak broadly today, it is best to consult with your financial advisor to discuss your individual circumstances before making any decisions that may impact your plan. A couple of housekeeping items. You may submit a question at any time during the discussion today using the Q&A icon at the bottom of your screen. I would also like to let you know that a recording of this webinar will be made available to you within 48 hours. So to transfer into today's discussion today, this webinar was really inspired by recent blog posts that were written by Adam and Erin. Adam's post is titled 5 Headlines to Ignore, and Erin wrote a complimentary piece titled 5 Areas to Focus on to Achieve Your Financial Goals. Both of these blog posts can be found at our website, summitry.com, under the Insights and Resources section. Now, Adam, your blog is fabulous, but I imagine that not everyone on the call has had a chance to read it. So maybe we'll just start by talking about what was your inspiration to write this blog, and what were some of the points that you brought up that are things that people can ignore?
Thank you, Cynthia, and thank you everyone for joining us this afternoon. So I think all of us are inundated these days with news headlines, whether it's on social media feeds, you're getting news updates on your phone, you're reading a subscription, and it's really difficult to filter through what is actually relevant. You know, we all have personal interests, but what's going to be relevant to your own financial picture? And especially over the last 2 years, there's been so much that's changed, so many headlines to keep track of, that we thought it would be good to explore what are the things that you might be okay ignoring, or what are the things that are actually going to be relevant to you. And as the title of the blog post says, one of the things we wanted to focus on was 5 things that are really not important. So these could be everything from what billionaires are doing with their money, if there are any billionaires on the call, congratulations, to the sort of things like, you know, what are free analyst reports saying, you know, the sort of things that probably don't have the intended effect and can probably just be discarded as part of your financial plan. Although it's one post, we could probably turn it into a series, because there's definitely a lot out there that's more noise than signal, but we wanted to start to tease out what's some of the noise. And then I think Erin's blog post is really starting to focus on what's the signal, what are we trying to focus on? So Erin, I'll turn it over to you if you want to chat a little bit about the other side of what we can pay attention to.
Yeah, absolutely. Thanks, Adam. And thanks to everyone for joining today. I love the structure, how it's going to be more of a conversation rather than a presentation. These are, you know, the real life conversations we're having with our clients. So really happy to have this today. Yeah, you can't really have an article on things that you should not pay attention to without having a balanced article on things that you should pay attention to. And there'll be kind of a common theme throughout this conversation that we're having today on things that you can control and take action on versus things that are kind of out of your control. And with, I think, Adam, your article did a great job of just highlighting all the noise, things not to pay attention to. And I think in today's age of just 24-hour news and headlines, it's really easy to get distracted by all of the financial noise out there. So my article really focused on what you can control, what you can take action on, things like tax planning. And I think it was very, timely at being Q1 of 2022 to really concentrate on tax planning and forward-looking planning for the current year, asset allocation, asset mix, time horizons, and really most importantly is how everything relates to your financial goals and your family and the things that you care about and what you're trying to accomplish in your life. So those are kind of the areas that I wanted to focus on in my article.
Great, thank you for that. Mandy, I'd really like to bring you into the conversation and transfer into our first topic, which is geopolitics. And there's no lack of headlines today with the Russian invasion of Ukraine that is ongoing and very devastating to a lot of people. It's kind of hard not to be taken by the headline. So as a financial planner, how do you think about events such as what is happening in Ukraine, and how do you advise your clients?
Yeah, thank you, Cynthia, for the questions. One of the things that we actually talked among ourselves is how much have changed just over the last 2 years, not just real politics, it's also COVID. And most recently is the Russia invasion of Ukraine. We were reminded how quickly things can change. One of the interview that I saw the other day from one of the UN Council that reminds us that we still have a crisis in Afghanistan. It's still a crisis. It's still a very devastating crisis. That show you how much the new change. But the conversation that we have with clients is the way we look at the financial plan is still the same. It doesn't fundamentally change how we approach financial planning because of the headline. For me, from my perspective, we're not trying to predict the outcome of this crisis. It's certainly beyond our expertise. But what we want clients to focus on is where they stand today, have a strong fundamental plan so that they can make educated decisions going forward. We may never know where we're going, but we better have an idea of where we stand today. For example, one of the prime examples that I have been going through with clients is certainly the crisis in Eastern Europe have put a lot of pressure on gas prices or the price of wheat that's going to put pressure into food price in general. However, if you know that food and gas make up only about 10% of what you're spending, just strictly looking at the number would help you put your mind into this, that it's not going to affect your spending a whole lot. It will affect a lot of people in other parts of the world. It's put a lot of pressure on hunger, but for our client perspective in general, that's not going to put a lot of pressure on their budget. And knowing that, looking at hard number, really what I see is it's really how clients have the peace of mind. Another example is looking at asset allocation and managing risk appropriately, really help clients managing their volatility into their portfolio. For many of our clients who in the distribution phase, for example, that they do have to take fund out currently, having appropriate amount in cash and short-term bond that is relatively less volatile is something that they can control, is something that will minimize the impact of any uncertainty in the future, because we know that market is going to bounce back. So in short, what I want clients to focus on is focusing on the part that we can do, managing risk, planning for the unexpected, diversify appropriately, and regardless of the uncertainty outside in geopolitics or anything like COVID, the plan tend to be more successful if the fundamentals are sound.
Awesome. That's wonderful, Mandy. I'm curious how both of you think about using historical context. I know that's one of the things that we sometimes get asked about, and we always hear past performance not indicative of future results, but it is sometimes helpful to look at difficult times in the past. So I'm curious how the two of you approach that.
I'll begin. Just historically, I'll begin because I'm the old guy on my decade. So I don't want to sound detached from what's going on in Europe. It's obviously horrific and atrocities are happening. These type of geopolitical events, they typically do not have lasting effects. I mean, uncertainty drives market volatility, and then once investors begin to grasp the scope of the crisis, the uncertainty usually abates and markets recover. I was reading a Barron's article the other day. They examined 50 different crises over the last century. So it's going back quite a while. But statistically, after the 50 crisis, after falling an average of 7% immediately after a crisis, the S&P rose 4.2% over the next 3 weeks. 9 weeks later, it gained 6%, and then after 18 weeks, it was up about up 9.6%. So those are kind of the statistics. Of course, these are averages. We've experienced more prolonged downturns in the market, like the recession in the early 2000s after the dot-com bubble, which was coincidentally when I started my career in 2000. Not an ideal time. September 11th attacks, 2008, 2009, the mortgage crisis. Markets generally react quickly. The price of a stock isn't valued based on short-term probability. Good companies are resilient and they can recover. I was reviewing a 10-year just historical performance report with a client last week, and of course there's concerns about what's going on today. It seems unprecedented. It really isn't that unprecedented what we're going through today. But we're going through a 10-year performance report, and we went through, this is when Brexit happened. This is when the Venezuela crisis happened. This was the annexation of Crimea in 2014. Here's when COVID happened, which resulted in supply chain issues, temporary shutdown of travel and leisure companies, really a change in the way we live our lives. And now we have high inflation, there's a war in Europe. And over the long term, the client has done very well over a 10-year period. It just speaks to the resilience of the stock market and really the value of having a strategy and long-term investing.
Yeah, Aaron, just listening to what you said about how short and how long it might take for the market to recover, it reminds me of one of the questions that I got from many clients is, Mandy, I know that the market gonna recover, but I might not have enough time, which I strongly disagree. I plan for all of my clients to live to age 100, which definitely a real possibility. But that's the reason why asset allocation is so important. Yes, the stock market might be having a pullback for a couple of years, 4 years. But if you have a portion of your next several months in cash, that's where you're going to pull it from. Also, most likely, if you actively in the distribution phase and you do need to pull out of the portfolio aside from the portion that planned for legacy, we'd likely to recommend, that's why there's still a play for bond in your portfolio, and also the reason why we remind clients to look at their current asset allocations so that they don't have to sell stock when the time is not right. And if you don't sell, if you don't take a permanent loss, then the sequence of return is not as important to you.
Yep. Mandy, addressing kind of the flip side of that as well, if you're in the accumulation phase, no one likes to see their portfolio drop, but if you're in the process of building up assets, this is arguably a more opportune time, at least all else equal, than putting money to work. If you're putting money to work consistently, in long-term dollar cost averaging in the accumulation phase, that volatility is maybe not to your advantage, maybe too strong, but it's something that you can use to continually build up your asset base and then hopefully take advantage of that long-term appreciation. So I think it works on both sides, as having a strategy, whether you're accumulating or decumulating from the portfolio, with the idea being you're not stuck doing something at a time you don't want to do it. And I think that's important too, is it's okay to, if this drop in the market has made you feel uncomfortable. I think sometimes what I hear is it's a little bit easy to high watermark yourself and be, well, I don't want to make any changes until my portfolio is back to X number or something like that. And I think we all know that we set these arbitrary numbers that are maybe not realistic, but I think it's important to listen to yourself. What we want to do our best to divorce what we want to do from a financial perspective from how all of us may feel personally. Those are two things that are sometimes hard to extricate. That being said, the last thing we want to do is kind of make a rash decision based on, that kind of emotional aspect. We want to be able to think through those sorts of things because it always feels unprecedented. But if we have a strategy, it's a little bit easier to go through. And I hear that word a lot, unprecedented. And I think that's the tough thing, is most of the things that we have been through in the past 2 years, many of them terrible and heart-wrenching, are precedented. And Aaron spoke to some of those precedents. So we don't want to necessarily over rely on them, but it's also important to know it's okay to listen to yourself. We don't want to be overly reactive, but don't set arbitrary benchmarks for yourself. I can't do something until X, or I have to wait until this war is over to do Y. If you have a plan in place beforehand, during, and after, it really shouldn't affect you, in terms of that specific element of your plan, the accumulation or the distribution strategy.
That's a good point, Adam, the accumulation phase. And kind of going back to what Mandy said, it's really important that you're in the right asset mix to begin with. The market, we've seen a downturn. It's interesting. I'll use an example. My wife loves to shop at Ross stores because she can go there and buy things at a discount. It's interesting that the stock market, a company's stock, is kind of the only thing that when it's at a discount, people don't want to buy it, which is completely counterintuitive to a good investment approach. Buy low, sell high. Kind of the psychology of investors. They want to buy stocks as they're appreciating, they're at the high water mark, as you alluded to, Adam, and want to sell when they're low. But younger investors who are accumulating, this is a great time to buy great company stocks at discounts.
I'd like to ask our panel one related question before we move on to our next topic. So a lot of people in our audience may have felt caught off guard by the invasion of Ukraine and then the corresponding volatility in the market. And then I think as a human being, it's natural to want to protect ourselves from the next crisis. And I know I speak with clients who feel with some certainty that China invasion of Taiwan is the next big shoe to drop. And so obviously, there's no way we can predict whether or not that will happen. But how do you speak to the desire to protect yourself from maybe the next event?
Cynthia, I wish, part of the point is we didn't come with slides or anything, but I wish I had some better statistics on this. But when you tend to see things like large put buying volume, out of the money put buying, which is an option contract that's usually used to hedge something like a black swan event, you tend to see all of that put buying after the market. There tends to be this kind of rush to buy fire insurance after the house is burned down, so to speak. And so I think it's important to not go, okay, what worked in the last month, and apply that to what's going to work in the next crisis, because we don't know what the next crisis is going to be. And different assets perform very differently in times of different crises. And so I think again, we're going to anchor to this all day, but reassessing the plan, its, ability to tolerate volatility, changes in the portfolio value, those sorts of things are very relevant. But I would caution people against, we do get more questions about things like commodities right now as a hedge or other sorts of hard assets, not speaking to the pros or cons of any particular asset class, but you do see with a lot of these more hedged asset classes that investor returns tend to be pretty poor because people leave when performance isn't great and then they rush back in right afterwards, and we get kind of the same herding mentality. So I understand wanting to protect from the next crisis, but just make sure that it's not just protecting against exactly what worked in the last crisis, I guess. I don't know, how do the two of you feel about that?
I think that well, it's impossible to predict what the next crisis is going to be. I think the fact that we have such a crisis in Ukraine is what the scale of it is a surprise to many of us. And China, the conflict between China and Taiwan have lasted for a very, very long time. There have been several trials, and people would say that it's almost certain. But again, there's no way we can predict that. And it's certainly beyond any of our expertise to try to decide whether China is going to invade Taiwan. It's coming back to if you make you feel comfortable, your financial advisor can help you run several stress tests in your financial plan to show if certain thing happen, how it would impact you personally. And it will impact everybody very different. I do have a client who's thinking about moving back to Taiwan for a few years after they quit their job. It's a real conversation that I have just a few days ago, and that's certainly that plan for that client. What will happen between China and Taiwan impact them much more than the client who's just going to live in the Bay Area and continue their life.
That's interesting, Mandy. I think you bring up a good point, which is, all of these events definitely do matter to some people's financial plans, right? In the case of your client who might be moving to Taiwan, that is a very real prospect versus, what are and I think it really speaks to what are the elements of your financial plan and how exposed are they to certain events. And what we generally find is not very exposed, but it doesn't mean that Cynthia spoke to, everybody's financial plan is different. And as you said, Mandy, for some people, those sorts of things could be relevant for their financial plan. We never handicap things also, but our research team definitely does think about these things when we're constructing portfolios. So maybe that's an important thing to know and maybe goes without saying, but just to reiterate here. And again, I just want to caution everyone against, there's a lot going on in the world, but it's so difficult to predict. So many things have happened. Gas prices have gone from negative to $100 a barrel in the last couple years. And all of that is arguably due to initially to COVID. And, there have obviously been things that changed since then. So if you would have asked me to predict, I don't think any reasonable person could have predicted oil prices would go from negative to $100 a barrel within the span of a couple years. And I think that also speaks to, hedging yourself against the most recent crisis may be the exact opposite of the next crisis. So it's really important to assess how might certain changes affect your financial plan with the knowledge that, hopefully none of these things will ever happen, but it would be unreasonable to assume there's never going to be another crisis.
Well, thank you, Adam. I think that's a good segue into our next topic, which really does not need an introduction. I feel like this topic is everywhere, from the news that we're reading to the prices we're seeing at the gas pump and at grocery stores. So, and of course, that topic is inflation. So I'll let you guys decide. Maybe Mandy will bring you in and you can start on this topic. But how do you think about inflation when you're trying to plan for the future?
Yes, I think we're going to come back to the same theme that people probably tired of hearing is every plan is different. Inflation in general, let's talk about inflation in general. It's measured the basket of goods that an average household consumes. Inflation gonna affect somebody who in the distribution play more than somebody who actively earning money. That it's likely that their earning power increase with inflations. And even for somebody in the distribution play, for many of our retiree clients, what you're spending on is very different than the average household. Take housing as an example. I dare to say that most of our clients own their home. So that part, with or without a mortgage, the housing expenses for you is fixed. If you have a mortgage, I would flip the equation to say that practically your housing cost going down because the monthly payment that you pay is fixed. When with higher inflations, the value of a real dollar is reducing. So on that end, it's practical to say that your cost actually going down as opposed to goes up as somebody who currently thinking about buying a house or currently renting. And housing cost is a big portion of how they calculate CPI. It's a 30%, well, over 30% of the regular CPI, and it's almost 40% of the core CPI. So if that portions, you take out that portion, the impact of inflation to your personal plan is significantly reduced. Another thing is medical costs. For example, I just looked at this morning, after a high increase in mid-2020 for COVID reasons, the rate of increase in price of medical costs is actually going down. Well, the price not going down, it's only go up at 1 or 1.5% as the number that I see this morning. So for a retiree who's spending a bigger amount of their budget in medical costs, their personal inflation is not as high as the 7% that you saw on the news. Gas and food, as I mentioned earlier, is also a big portion of the regular inflation. But we are fortunate to say that none of our clients experience food insecurity. So food and gas is not a big part of their budget. So if food and gas, say, make up 10% of your spending, and even if you apply 20, 30%, 50% increase on those areas, it's not going to impact your budget a whole lot, and it won't impact your spending. So I think it's important to look at what you're spending, take a closer look at how the monthly expenses go, and you will see that fortunately, for many of you, you don't have inflation will impact you not a lot. Now, for many of our younger clients who thinking about buying a house or gonna buy a new house, that is a very different question, and that is something that we certainly want to make sure that we plan for.
That's a good point, Mandy. And inflation is very personal. I think, historically, inflation has been about 2.5%. Last time I checked, it was 7.9%. That was a couple weeks ago. I'm not sure.
Who knows at this point, Aaron? Who knows?
Who
8,
knows?
9, anyway.
But it's very personal, and people kind of take that small basket of goods that Mandy mentioned, and you hear 7.9%, and it's a terrifying number. I would recommend people look at their personal inflation, which is more applicable to them than just this general basket of goods. For example, I have 3 kids, and I'm planning for college, which is terrifying to me as a dad. But historically, inflation on education has been much higher than general inflation. It's been about 6.5%. So that's very much applicable to me. On the flip side, I live 4 minutes from the office. So the $125 to fill up my tank, it doesn't really affect me that much, opposed to, like, Cynthia, you live in San Jose, you have over an hour-and-a-half commute to work and back. It affects you a lot more than me. So I would tell people, to focus on what is really applicable to their situation, and not just look at inflation as a whole.
Well, and Aaron, you forgot to mention 2 teenage boys, so my food costs are also impacted.
Well,
no one's average, right? That's the problem with averages.
Exactly.
Is all of us, you could average out, maybe all of our inflation rate on this call is 7.9%, but some of that's, I think we're hitting on the point, right? Is it's, if you have two teenage boys and you have to buy them food, right? That's expensive. Childcare, there's a whole sort of costs. Whereas, and so I think that's why when we look at those headlines, this was part of, not to sell my blog post again, but that was one of the reasons that inflation listed on the things to ignore. Mandy touched on some of the excellent technical aspects of it, and Aaron touched on the element of no one is average. I think, I don't know if anybody, what's average gas prices are now like $4. Mm-hmm. I haven't paid $4 a gallon for a long time buying gas. So I think maybe another good inflationary example of no one experiences, the same rate of inflation.
I would say too, just it's the beauty of financial planning, and in our planning software, we can create an infinite number of what if scenarios and big financial decisions. And inflation is one of those numbers where we can assume what it's going to be in the future, but worst case scenario, if inflation continues to increase, we can build that into the plan, not just on average, but if inflation on tuition increases or anything that's really specific to you, and home prices, if that continues to increase at the rate that they are, we can build all of that into the plan and run different scenarios to see how these different factors actually affect your overall financial plan and what you're trying to accomplish.
Yeah, not to sell the financial plan again, but sometimes looking at hard number on paper or on the screen nowadays is really give you a way to rationally think about different things, because it's hard not to think about how food prices increase, how gas prices increase, because you go, your mortgage payment is usually auto pay, but you go grocery shopping every week, you fill up your gas every week, so that's going to be the thing. It's more, but it's top of mind for most of our clients. Only when you look at looking at hard number of how your spending go, you would have a more rational way of looking at budget and how different things impact your budget over time.
I love that, Mandy, that the idea that food and gas prices are the ones that we anchor to. There's a psychological concept of availability, the availability heuristic, right? The things that we see and interact with are the things that we perceive as the most relevant, even though, like, logically, I know that I'm going to spend more on housing than food, and I know what my housing cost is, but I think it's important to extricate those. And just knowing that, I think, is an important tool in your arsenal, knowing that we tend to over-index to things that we see regularly. And we don't think about things like electronics, which, despite recently, have actually, I mean, if you bought a TV recently, you might have paid the same amount that you paid several years ago, and it's of a much higher quality. And that's just not something we think about because we don't interact with it every day. So that's the tough part of inflation. So personal aspect. And then I feel like we'd be remiss if we didn't take 30 seconds and talk about the effect on your portfolio, because as much as the financial plan, we want to make sure that the businesses that are owned within your portfolio are also going to keep pace with inflation, because that is what's going to generate the purchasing power. So on the equity side, the most important thing is owning the sort of companies that can raise their prices. And what does that mean? So that means the product is either, relevant, in desire, or irreplaceable to the point that they can either raise price. And we're not going to talk about specific companies today, but I think the qualities of them, which is the ability to raise prices to keep up with inflation so that their earnings and revenue growth can either meet or exceed inflation. And ideally, the best companies can raise their prices faster than inflation because they're providing usually so much value or consumer joy or irreplaceable function in some supply chain that they're able to increase that value over time. And then on the fixed income side, if you've owned 20-year treasury bonds for the last 40 years, you've done nothing but make money. And I think it's really important to have a fixed income team, or if you're managing any fixed income, to look at things like, what is the duration of your portfolio? How sensitive is it to interest rates? We often might hear something like, well, I'm going to go to cash because I don't want any risk in the portfolio. Well, you've just traded equity risk for inflation risk, or if it's bonds, duration risk, credit risk. And so it's been easy to kind of throw darts at a wall. But if we do have an extended period of rising interest rates, people who haven't appropriately positioned their bond portfolios, I think will regret that. And so having a team that's managing those sorts of things, whether it's the type of issues owned, the type of asset classes owned, or the specific characteristics of any of those, it's important to manage because, as Aaron said, historical inflation is what, slightly over 2% versus, what we've been experiencing now is definitely a different environment. So those two things do have to work in concert. We want a portfolio that generates the sort of purchasing power that can then be used in your financial plan.
Yes, having sufficient equity exposure in your portfolio is one of the best way, if not the best way, to hedge against inflation risk.
Great. And Mindy, I want to comment on something you mentioned earlier, that people who are in the accumulation phase might not feel inflation as much as members of our audience in the distribution phase. And one thing that came to mind for me is also a lot of types of fixed income are pegged to inflation with a cost of living adjustment. So I think about Social Security or pensions or annuities.
Yes.
We may be getting bigger raises this year because of the effects of inflation as well. So I think there is an income element to it as well as an expense element. So I'd like to transition into our last topic today, which is income taxes. We're at the time of the year where we are either just finishing up our returns or kind of knee deep in terms of thinking about it in the next few weeks. And I know for many people, gains were significant last year. And so people may be writing larger checks this year than they have the last couple of years. And so, Mandy, I'd like to start with you in terms of talking about what are some of the biggest areas of our life or times in our life when taxes might have the greatest impact?
Yes, thank you, Cynthia, for the questions. Well, one of the things throughout my life of being an advisor, I saw that client is really interested in what is the next tax proposal, how tax is going to change in my lifetime. And it's not something you can control. Like if we have this webinar just a few months ago, certainly we would have questions about what happened if tax rate increase in the future. What if the highest marginal tax go from 37% to 39.6%? How that gonna impact my financial plan? And those are the things that outside of our control. I don't have any of those questions anymore because anybody remember Build Back Better? What you should focusing on is what different phase in life. If you, one of the things that not many people think about is when they turn 63, assuming you in retirement and you're no longer in the employer medical plan. You're going to have enroll in Medicare at age 65, and your premium is based upon your modified adjusted gross income 2 years prior. So you don't want to, you want to have a look at how much you make in terms of capital gain, in terms of dividend and interest, including California muni bond. To see, you don't want an extra 1,000 in income result in 2,000 or 3,000 additional in premium. That's the situation that we want to avoid. The other thing, one of the prime example is Roth conversion is one of the questions that I get a lot of questions on. There will be periods of time, for most of our clients, there will be periods of time between after they retire and before required minimum distribution kick in. There's, for many of my clients, there's good decade that you will be in lower tax bracket. And we want to make sure that we fill that with income to take advantage of the 22-24% tax bracket for Roth conversion, so that in the future there's less income to be paid at the 32, even 37% bracket. So between like 20, what I like to see is 24 and 32 is 8% difference that we should be taking advantage of instead of worrying about tax rate increase from 37 to 39.6%. We like to, last thing I'm going to mention is we like to say that we don't want tax to dictate how we manage the portfolio, but it's important to take loss when it's available in the year that you're in a high tax bracket. So looking at your portfolio at the end of the year with your advisor to take advantage of any tax loss harvesting opportunity, particularly in a year that you in the higher bracket than normal, is very important.
Yeah, I would say those are great points, Mandy. And I remember, in the beginning of the new administration, there were just so many tax proposals out there and so many client meetings of, questioning whether they should realize all of their capital gains because the capital gains rate's going to increase because, Mandy, as you mentioned, the ordinary income tax was going to go from 37 to 39.6, all of these different proposals in the legislation, and hardly anything was actually passed. So it's really important to plan for what you know. All of the proposals, there's going to be quite a few different variations until something may or may not pass. So plan on what you know, but also be aware of what proposals are out there as well. I would say, just to follow up on what you said, Mandy, just being proactive throughout the year for tax planning. I tell my clients this all the time. Usually tax preparers, all they are backwards looking. They basically collect everything you've done in the year prior, plug it into tax software, and they file your return. There might be a few things that you can do by the tax filing deadline, like IRA contributions or solo 401k contributions or things like that, but there's very little you can do after December 31st. Being the beginning of the year, I think it's a great opportunity now to do some tax planning for the current year. First is to make sure that you're withholding enough from payroll, and your employer will not recognize the income that your spouse is making as well. So if you claim too many exemptions, there's a very good chance that you're going to be owing at come tax filing deadline. Things like RSUs, which many of our clients have, your RSUs vest, they will sell and send about 22% to the IRS to pay for taxes, but the highest tax bracket is 37%. So there's a huge delta between what they're actually sending to the IRS and what you may or may not know, especially if you're in a dual high income household. So very important if you have RSUs to tax plan throughout the year or even quarterly. And with ISOs, I've had quite a number of clients, even just the beginning of this year, exercise ISOs, and it's not necessarily a taxable event when you exercise ISOs if you hold on to them, but alternative minimum tax could come into play if you exercise, and that is an unfortunate surprise to many people who exercise options, hold on to them, and then have this massive A&T no income tax time. And it's, I think I mentioned in my article, it's one thing to pay the taxes that you owe, and we can be very tax efficient and try to minimize taxes wherever possible, but paying penalties and interest on under withholding is just completely unnecessary. So absolutely plan for withholding.
I mean, let's do a show of hands on this call. Who's seen an underpayment penalty recently on one of your clients? You don't have to raise your hands. No, thank you, Mandy. But in all seriousness, I think we've all seen a shocking amount of underpayment penalties. Aaron spoke to one of the reasons, and there's nothing wrong with paying taxes that you're legally required to. Nothing wrong with paying a professional to prepare them. I think most people would agree that if there's an easy way to avoid paying more money that is strictly due to penalties and interest, that is a win, right, on the things we can control. And it's, we spent a lot of time talking about, 37 versus 39.6%. I think Mandy did a great job of illustrating, 8% is a substantially bigger difference, and that's just optimizing within your life. There are things that we know are going to happen. There are many provisions of the 2017 Tax Cut and Jobs Act that will sunset in 2025 with no action by Congress. So there's not another bill that needs to be passed or anything like that. So certain things like the lowering of the estate tax exemption, which is at a historically high level of approximately 12 million per person. So we do know things are going to change. And so we want to refocus our energy as much as possible on, okay, we know things are going to change in 3 years absent any action. That is kind of already the default option. What planning could we do now? Mandy brought up a great example of two of thinking 2 years ahead for Medicare, what could we be doing now to make a difference in 2025, whether we're talking about converting, estate planning. There's a lot that could go into it, but we do know things are going to change. So let's focus on those instead of, like you said, Mandy, is Build Back Better. There are about 17 different tax proposals that we had to read through last year, and at the end of the day, not much changed.
Well, thank you. I really appreciate all of you sharing your comments and ideas with our audience today. I do want to leave some time for Q&A. So as a reminder, if you do have a question related to anything personal finance related, please feel free to click the Q&A icon at the bottom of your screen, and you'll be able to privately type in your question. So the first question we received is around charitable giving. So when our portfolios and our net worth statements are higher, I think we all feel more freedom to give generously. And also when we see crises of the magnitude we're seeing now, I think we're all more motivated to give as well. But when we see downturns in the market, I think it's natural to maybe retract some of that charitable giving. And so the question is, how do you create a plan that has a component of charitable giving when your net worth may be going up and down month to month, year to year, quarter to quarter? So yeah, throw that out to our panel today.
I will start with having a plan, putting a number into your financial plan as considered the charitable giving as one of the things that we plan for, give you more freedom to spend, because it's in the plan. It's you're gonna give 10,000 every year, and that show that you still be okay. That give you the more freedom to spend. Now, also knowing that you're gonna give allow for much better tax planning as opposed to in the year. For example, we have many of our clients put appreciated stock into a donor advised fund. That fund is you take the charitable deduction or the fair market value, you not have to realize the long-term capital gain. For many of the clients in the higher tax bracket, I saw the IRS and the state of California subsidize up to almost 70% of their gift to charity, or have a bucket have a designated bucket for charitable giving. I also see that give clients much more freedom to give from that bucket because it's not affect the other area of their life. There's also our client who qualify for qualified charitable gift from their IRA, giving from the IRA account to what require minimum distribution, and that effectively reduce their taxes in a big way. So that's also having the IRS in the state of California subsidize your gift is a great way to give.
That's great. And thank you. I think in the interest of having the opportunity to ask other questions, I'm going to ask Adam and Aaron to refrain from adding their comments. I think, Mandy, you did a great job of addressing that question. So part of our job as advisors is to be educators, and I'm not surprised this question came up. Aaron, could you briefly explain to our audience what an ISO is?
An ISO, it's an acronym, and there's a million of them in the financial world. It's an incentive stock option. So many employees, especially here in the Bay Area, a large component of their compensation is given in the form of equity. Incentive stock options are something that your company gives you at a set price, and when you exercise it, you basically buy the stock at that predetermined price, and you're able to either hold on to it or sell it at the current market value. So exercising, it's only a taxable event when alternative minimum tax comes on board, which we could spend an entire other webinar on AMT, so I won't go into that. But yeah, if once you sell, it's also a taxable event.
Great, thank you for that explanation. You know, the questions are as varied as the work we do. It's like personal finance is so broad, so I apologize if I'm hopping around a little bit, but I think, Adam, this is a good question for you to address. so often we see short-term trends in the market, and we could probably list 2 or 3 right off the bat that come to mind. But how do you, as an advisor, acknowledge that those short-term trends exist, but also contrast that with being a long-term investor and maybe the value associated with that?
Yeah, that's tough, right? Because it's, if we look over a 20-year time frame, it's really easy to go, okay, well, this is a great thing to do. But from time to time, we see whether it's euphoria or something's in trend or something's out of favor. I think there's a couple things that are really important. Number one, is the investment strategy sound logically and fundamentally supported? Not necessarily, I mean, there's fundamental research that goes into it, but if the strategy can't be explained to you relatively easily, it's probably not a good investment strategy. It's probably an overgeneralization, but I think that's a good point. So what we do at Summitry, what our research team does, is buying high quality companies at a discount to their fair value. It's not a terribly, the execution is the difficult part, but I think, it's very easily explained in one sentence. I think the thing that's important about that is there have definitely been periods, I can't tell you how many articles there have been written about the death of value stocks. They tend to come around right around the time before better valued stocks tend to do very well. There also seems to be a correlation where Warren Buffett gets insulted more and more as value stocks are about to do better. So I think it's just a good example that it's really easy to swing back and forth, but we have seen a lot of the kind of trendier, maybe you could call them the COVID pick stocks that have maybe come back down to earth in a rather tough fashion. Whereas companies that are generating positive cash flow, that are growing that cash flow over time, A, we haven't seen as much of a drop in valuation, but B, when we see moments like this, it does validate fundamentally that although the market may temporarily become fascinated with
fill in the blank.
SPACs, oil companies. I mean, how many trends have we all seen? I mean, and how many hyped pitches? We've seen a lot of different things, but if the strategy hasn't worked for a long period of time, which is axiomatically, there are only a few things that have a strong track record. So sticking with those, knowing that there's a fundamental logic behind them, right? We can calculate the value of a business and we can understand what that business does. What we can't predict is whatever the new leveraged ETF is that's going to crash the VIX or one of those ridiculous things that you hear create. We can't control whether hedge funds are going to take out a big short position against a stock. And frankly, we like those opportunities. We never want to see the market go down. All right. It's a knee-jerk reaction. But when those sort of very technical, whether it's, people have blamed it on everything from, overly concentrated funds or new derivatives, whatever you want to chalk it up to, when people throw out all kinds of good companies because they've blown up some exotic financial product or it's fallen out of favor, that's when we get to pick up amazing companies at a discount most of the time. It's when people have royally messed up by getting overly involved in whatever the latest fad du jour is, whether it's the new fund or new asset class, or anyway, we could probably do a little more time on that. But if there's a fundamental logic, a time-tested approach, you got to know that it's going to underperform at times, but that's because people change their mind over times, but value doesn't change.
Perfect. Thank you. Mandy, I'd like to go back to you. Follow-up question around charitable giving. If I'm in a situation where I'm subject to a required minimum distribution, and you might spend a moment just to define what that is for our audience, is using that, if I don't need the income for living expenses, is it a good idea to consider using those funds for charity?
Yes, absolutely. So as of now, retirees need to take their required minimum distribution at the age of 72, and that's based on the remaining life expectancy. The quick rule of thumb is roughly more or less around 4%. So that's the amount that you require to take out every year. Now, after you turn 70 and a half, you are allowed to take the fund and give it directly to charity. So this would be a direct distribution, a check that written to charity directly as opposed to written to you. If that part, say your required minimum distribution is 100,000 this year, you give 50,000 directly to charity. That would be 50,000 that not count toward your taxes. Only the remaining 50,000 would be considered taxable income to you. This is very much better than the other way when you take the taxable income and give to charity and try to take the charitable deductions. One, you may not itemize your tax return and be able to take the charitable deduction at all. So you would not have any tax benefit from the charitable gift. And most of the time, it's much better to have an above the line, well, I say it like even above the line deduction, because it's not counted toward your income at all. So it's not part of the modified adjusted for income that's going to impact your Medicare premium, for example. So in any situations, not counting it as a taxable income in the qualified charitable gift is always better than counting it as income and have to take a tax deduction and take a tax deduction. So whenever client eligible, it's always the route that I recommend.
It's important too that the check go from your IRA directly to the charitable organization and not to you first. If it goes to the charitable organization directly, then it's not counted as income during that tax year.
And it's important to let your CPA know that the check goes to charity, because you still receive the same 1099. But you need to make your CPA or whoever your tax preparer, if you prepare yourself, to let TurboTax know that this is the portion that goes directly to charity, because it will reflect on your 1099.
Great.
And
Thank you.
Cynthia, if I could add, yeah, go ahead. Let's go to the next.
I think we have time for one more question.
Sure.
And I would like to ask our audience to stay on to the very end, because I do have an announcement about an upcoming webinar that may be of interest to you. So in terms of our last question today, oftentimes our employers give us the option when we retire to shift our funds into an annuity and then get income for life from that annuity. And so if you could briefly comment on the pros and cons of that consideration, and then also specifically, what is the tax treatment of the annuity payments that come out of the retirement plan? So Adam, I will let you start if you would like, since
can we go back to the qualified charitable? No, this is I'm going to start this by saying that this is definitely a question that I would recommend you discuss with your advisor, because there's a lot of nuance that goes into this. But there is something understandably attractive, right, about turning a lump sum into a stream of payments, especially given market volatility. It can be comforting to have that idea of, okay, I know exactly what a paycheck is going to be. The pros and cons. You want to understand that generally this is a fixed contract into when you're entering. So there's going to be terms as to how you can get out of the contract, how soon you can do that, whether or not you can. They often may have fees associated with it, which, depending on your goal, may be reasonable, but at least historically have been accused of being fairly high. And I would also be careful, because a lot of these may come with expensive riders. That and a rider being an optional feature that gets thrown on there for which there's an extra charge. And really, annuity payouts are a function of interest rates. So in a low interest rate environment, annuities, it's not that annuities aren't favorable, it's just that annuities are going to have a lower payout than if short-term interest rates were higher. In terms of taxation, if the money's coming out of a qualified plan, so out of a 401k, coming out of an IRA that you've rolled over your 401k funds into, it will be taxed just as any other IRA distribution. When the funds leave the account, it will show up in the same way as if you had a IRA brokerage account that you had the funds distributed from. What I would highly recommend is that your options, that you bring them to your advisor, have them discuss them with you, whether or not they're appropriate. We are seeing sometimes employers offering a newer annuities that may be slightly more favorable, but they do sometimes get a bad rap for a reason, and it is important that you have an advisor who can evaluate, are the fees appropriate? Is the income stream appropriate? Do you need this income stream? And when should it be available to you? So,
well, thank you.
Yeah,
thank you for that. And I think as we started, certainly if there are situations that are specific to you individually, having the chance to speak to an advisor is always a great idea. So I would like to thank our audience for joining us today and announce we will be hosting our next investment webinar on Thursday, June 9th at 11 o'clock. We hope you found this discussion very helpful today, and thank you for joining us and have a wonderful day. Thank you, everyone.
Thank you.
Thank you. Bye.